Hey everyone! Today, we're diving into the fascinating world of currency markets and the British pound's performance against the US dollar. Now, I know what you might be thinking, another currency analysis. But trust me, this one's a real eye-opener. So buckle up as we explore why the pound is hanging onto its gains and what it all means for the global economy. First things first, let's talk about the numbers. The British pound has been showing some serious resilience, clinging to its two-day gains and hovering around 1.3500 against the mighty US dollar during the Asian trading session on Tuesday. That's a pretty impressive feat, considering the market's pricing out the possibility of an interest rate hike by the Bank of England anytime soon. But here's where it gets interesting. Despite this, the pound is still outperforming. Now, let's zoom in on the data. This week, the pound has been the strongest against the Japanese yen, with a 0.89% change. That's a significant jump. But what's even more intriguing is the heat map, which shows the percentage changes of major currencies against each other. It's like a currency chessboard, with the pound making strategic moves. Strategists at Rabobank are keeping a close eye on this. They're saying that the market is currently pricing in a reduced expectation of a rate hike by the end of the year. That's a big deal, folks. It means the pound's resilience might be more than just a fluke. And get this, the major trigger for the British currency this week is the preliminary UK Q2 and June month gross domestic product, GDP, data, which drops on Thursday. Now, let's shift our focus to the US dollar index, DXY. It's trading almost flat, holding on to Monday's recovery move. But here's the twist. The US dollar is expected to remain sideways as investors await the US Consumer Price Index, CPI, data for July, which drops on Wednesday. And get this, Elias Haddad from Brown Brothers Harriman thinks the upcoming US July CPI report will show inflation firming modestly, but not signaling a renewed acceleration. So what does all this mean for the Federal Reserve's interest rate expectations? Well, the July monetary policy statement showed heightened concerns among policymakers toward upside inflation risks. And lately, traders have priced out the possibility of a Fed interest rate hike in the September meeting after the release of weak U.S. non-farm payrolls, NFP, data for July. It's a delicate balance and the Fed is walking a tightrope. Now, let's dive into the technical analysis. On the daily chart, the pound sterling to US dollar is trading at 1.3500, retaining a bullish near-term tone. It's holding above the 60-day exponential moving average, EMA, at 1.3403, and the broken downward resistance trend line, which now offers support around 1.3456. The relative strength index, 14, at 61.1 leans into positive territory, suggesting buyers are in control. But here's the catch. Immediate support emerges at the former trendline cap turned floor near 1.3456, followed by the 60-day EMA at 1.3403. If the pound sterling to US dollar defends these layers of underlying support, it could continue to favor the topside, with bulls eyeing further gains above the recent 1.3509 close. So what's the takeaway? Well, the British pound is hanging onto its gains, and there are some interesting factors at play. From the market's pricing out of interest rate hikes to the upcoming GDP data, it's a complex web of economic indicators. And with the US CPI report and the Fed's interest rate expectations in the mix, it's a volatile time for currencies. In my opinion, this whole situation raises a deeper question. How do central banks navigate the delicate balance between inflation and economic growth? It's a challenging task, and the consequences can be far-reaching. So, what do you think? Is the pound's resilience a sign of things to come, or just a temporary blip in the market? Let me know your thoughts in the comments below.